Plug Power is currently trading at $2.42, down about 3.6% on the day. The stock has been bouncing between a low of $2.35 and a high of $2.46, all on significant volume of over 40 million shares. The immediate expectation for many watching this stock is that it's finding a bottom, a floor, after a brutal year, especially with third-quarter earnings scheduled to be reported on November 10th. The reality, however, is that this stock has become one of the most contentious and polarized battlegrounds on Wall Street. The consensus hold rating from analysts is a mask, hiding a deep and fundamental disagreement between a minority of analysts who have strong buy ratings and an almost equal-sized camp with strong sell ratings. This isn't a stock people are lukewarm about. It's a name that inspires either total conviction or complete dismissal, and today's price action is just the latest skirmish in that much larger war. Most investors see the steady stream of press releases and get hopeful. They see the news from 2 days ago about Plug beginning a 5-megawatt electrolyzer installation in the Netherlands. They see the headlines from last week about expanding a partnership in Uzbekistan for 2 gigawatts of electrolyzers. They even saw the update in September that its Georgia green hydrogen plant had a record-breaking month. The expectation is that this is what execution looks like. This is a company building the future. But the market is looking right past those headlines, and the stock is still down, trading near its 52-week low. The challenge for investors is to ask why. Why is the stock not responding to this seemingly good news? The reality is that the market is no longer trading the promise of hydrogen. It's trading the brutal mathematics of Plug Power's balance sheet. What the daily chart is screaming isn't long-term growth. It's persistent cash burn. The market is far less concerned with 2030 plant capacity and far more terrified of the company's financial statements. Let's look at the reality of those numbers. In the first quarter of this year, the company reported a gross margin of negative 55%. That means for every dollar of product it sold, it cost them more than that just to produce it, before even factoring in research, marketing, or corporate salaries. While that negative 55% was an improvement from the negative 132% the year prior, it's still a catastrophic financial leak. This leak is funded by one primary source: shareholder dilution. Over the past 12 months, the total number of shares outstanding has grown by nearly 35%. That is a massive dilution of existing owners, and it's the core of the bear thesis. The market sees the new plants in the Netherlands and doesn't think future revenue, it thinks future costs that will require raising more capital and diluting shareholders even further. This is the tension driving the stock. The expectation is growth, the reality is the cost of that growth. Now let's talk about the group of investors who have been proven correct for most of this year, the short sellers. This is not a stock with a small, cynical group betting against it. Plug Power is one of the most heavily shorted stocks on the entire market. As of the last reporting period in mid-October, there were over 331 million shares being held short. This represents an astonishing 30% of the company's free-floating stock. To put that in perspective, this is a $1.28 billion bet that Plug Power's stock price will go down. These are not retail traders. These are large, institutional funds with deep conviction that the company's business model is fundamentally broken and that its valuation is disconnected from its financial reality. They are betting that the cash burn is a death spiral and that dilution will eventually send the stock back to its sub-$1 lows. However, there is a fascinating and crucial detail in that short interest data that you must be aware of. While the 30% figure is massive, it was actually a 13.7% decrease from the reporting period just 2 weeks prior, which showed 383 million shares short. This is a critical development. It means that in the run-up to this earnings report, a significant number of short sellers decided to close their positions and take their profits. This can be interpreted in 2 ways. The bullish take is that these shorts are getting nervous. They fear that the company's Project Quantum Leap cost-saving program might finally be working, that margins might show a dramatic improvement, and that the upcoming earnings on November 10th could be a positive catalyst that ignites a squeeze. The bearish take is that this was just normal profit-taking after the stock's long decline, and that the remaining $1.28 billion in short positions represents the smart money that is holding on for the final leg down. What's your take on that 13.7% drop in short interest? Was that smart money getting out before an earnings beat, or just regular profit-taking? Let me know in the comments. For those of you holding this stock or thinking about trading it, this massive short interest makes it a completely different animal. You must know how to track this. You can go to any major financial data website and look up plug short interest. But don't just look at the percentage. You need to find the borrow fee rate. This is the interest rate that short sellers have to pay to borrow the shares. Because the stock is so heavily shorted, the borrow fee is likely elevated. If you suddenly see that rate spike, it means shares to borrow are becoming scarce, and the cost to bet against the stock is rising. This is a classic precursor to a short squeeze, as it can force shorts to buy back shares just to stop the bleeding from the fees. Another metric to watch is the days to cover, which currently stands at about 3.3. This number tells you how many days it would take for all shorts to buy back their shares based on average trading volume. At 3.3, it's not exceptionally high, which means shorts are not necessarily trapped. They could likely cover their positions in a few days if they needed to, which could blunt the power of a sustained squeeze. This entire dynamic is reflected in the retail investor sentiment you see on platforms like Reddit and X. The forums are completely polarized. On one side, you have the long-term believers. These are investors who are buying at these lows, who see the 69-cent 52-week low as the absolute bottom. They talk about the golden future of hydrogen, the massive government support through the Inflation Reduction Act, and the company's progress in building its plant network. They genuinely believe this is a generational buying opportunity. On the other side, you have the realists and the bears. These are investors who have been burned, who point to the years of broken promises, the endless dilution, and the simple fact that the company has never been profitable. They are warning new investors that the stock is cheap for a reason and that it could easily revisit its lows. For anyone who is new to this story, Plug Power is essentially an all-in bet on the hydrogen economy. Its business is built on two main pillars. The first is its legacy business, selling hydrogen fuel cell systems primarily to power forklifts in the material handling industry. Their anchor customers have been companies like Amazon and Walmart, who use them to run their massive warehouses. The second and far more ambitious pillar is their move into becoming a vertically integrated energy company. They are not just selling the fuel cells, they are trying to build the entire hydrogen supply chain. This includes manufacturing the electrolyzers that create hydrogen and building their own green hydrogen production plants like the ones in Georgia, New York, and Texas to produce and sell the fuel themselves. This strategy is what fueled the parabolic stock price run in 2020 and 2021. The expectation was that Plug would become the Exxon of hydrogen. The reality is that building a global energy infrastructure from scratch in a high interest rate environment is one of the most capital-intensive and riskiest ventures imaginable. The stock's collapse from its highs above $70 is a direct result of the market's shift away from funding speculative dreams to demanding cold, hard profit. This all brings us back to today's trading and the upcoming earnings report on November 10th. The market is braced for a loss of about 13 cents per share. Interestingly, this is a significant improvement from the 25-cent loss in the same quarter last year. However, the market is also expecting revenue of about $170 million, which would be a 2.1% decline from the prior year. This is the core conflict. The bull case is that Project Quantum Leap is working, costs are coming down, and the company is steering towards profitability, even if revenue is temporarily lumpy. The bear case is that a decline in revenue is unacceptable for a growth company and shows that demand is weakening, which, when combined with their cash burn, is a fatal combination. The reaction to the earnings report will hinge entirely on which of these narratives the company's numbers support. Looking ahead, the path for Plug Power is precarious. The bull scenario rests on the company explicitly demonstrating that its cash burn is slowing down and that its gross margins are rapidly improving from that negative 55% mark. If they can show a clear path to positive cash flow, the $1.28 billion in short positions becomes a massive pile of fuel for a rally. The bear scenario is simply more of the same. Another quarter of massive losses, vague promises about the future, and hints that they will need to raise more capital soon, further diluting shareholders. If that is the case, the analyst consensus price target of $2.29 could start to look generous. Next week, I will be watching the options chain closely. A heavy skew in open interest towards put options would signal institutions are hedging their bets or placing new wagers on a decline. Before we finish, I want to know what you will be watching for in the earnings report. Comment below with margins if you're focused on profitability or revenue if you're focused on growth. So, as we watch Plug Power bleed another 3 to 4% today, we see it's not just random market noise. It's the market's anxiety and skepticism personified, a company holding its breath before a critical test. The long-standing expectation has been that Plug Power is a key to our green energy future. The immediate reality, reflected in today's price, is that it's a company fighting a desperate battle through its own financial survival, against a mountain of debt, a history of losses, and a billion-dollar wall of short sellers. The story is no longer about the hydrogen dream of 2030. It is about the cold, hard reality of the 2025 balance sheet.